Hello everyone, this is Futures Trader, and in this I'm going to talk about key levels that I know about, and it'll start off with the easy stuff and go into more advanced stuff as the video goes. So for those of you that have kept up on my YouTube channel already, you may have seen that I did a video about trend lines not that long ago, and I wanted to start off with talking about this to say that trend lines are great for trading and they can help you determine when a trend is ending and a reversal might occur. They're not everything. Trend line breakouts can fail. And that happened recently where I wanted to trade this thing when it was in a downtrend under a trend line for a while, hitting, and it looked like it broke out. But I've been seeing this happen a lot now where things appear to have a bullish breakout, but then they fail. I really think what's going on is, the hype of the bull run is ending, and things people want stuff to be bullish, but it just doesn't hold. Say like this thing kind of looked like I thought it was going to hold, but it just fell through again. Probably because Bitcoin dropped at the same time, but it could have had buying pressure and it could have broke out, but it didn't. So you will have these trend lines that are just duds. I mean, or a breakout that's a dud. It may look like a good move this time here. You might have been able to catch it, but usually you want to wait for a recheck and then price to go. And this recheck failed. So this is why you want to know about key levels and why they're more important than trend lines. So I'll start off with Bitcoin on the monthly on a clean chart. And I want to say this because a lot of people know about this, but when I was a new trader, I didn't want to look at the monthly or the weekly or the daily time frame because I was trading on low time frames. But later I learned that when you draw your key levels using the higher time frame charts, the key levels are much more solid, and price will have a bigger reaction from a key level that's drawn from a high time frame. And I've seen it so much now at this point, and that's why it's so ideal to start with these high time frames. It looks boring, the candles look weird because they're just big and bulky, and it doesn't look like there's much here, but there's a lot here, really, that I'll show you. Now, a lot of people may not want to draw their key levels. They just might want to use indicators and trade and make some profit. But your key levels is a kind of work that you need to do. So there's this quote I wanted to share by this Mike Hawkins guy. And it says, you don't get results by focusing on results. You get results by focusing on the actions that produce results. So, you may not want to draw your key levels. You may want to just be lazy and use indicators and have an algorithm or something to trade for you so you can make passive income. Who doesn't want that? Well, you're going to get your real results when you do the work, when you focus on what it takes to get those results. And that's what this video is about. The key levels are exactly what you need. And that's why I wanted to make this video like one of my first videos in this series of videos that I'm making right now, because key levels are arguably one of the most important things in trading. You could say price action is king, and it is, or volume is king or queen or whatever, and it is. It's very important, but key levels are the cream of the crop. So I'll start off with talking about support and resistance. Everyone has probably heard about that. And I'll just look at the weekly time frame and just do some basic stuff. And I'll go really quick on this because support and resistance is something a lot of people know about. So this here could have been a resistance zone where you had price rejecting and it couldn't get above it. So that's like resistance. Price was resisting being able to get above that. It's quite simple. And like here, you may have had support. And, I'll show you why. Let's do it here for now. Why I'm going to say, why I do this the way I do, why I draw these rectangles where I do. So I use this rectangle tool here. It's on my favorites bar, and it's over here. But basically, whenever you see a wick on a candle, when you use the regular candles, you will have an idea that there's some sort of buying or selling pressure, something going on there, where price is trying to go through an area, but the bulls or the bears prevailed against the other and then reverse the price. So you may have seen this. If you started this here, you would say, oh, that's support. There's wicks on it. So if you see wicks, you know there's a key level somewhere. There's, especially if it's a big wick on a high time frame, that means there's a key level. So there's got to be a key level on these wicks. So if you drew this, even on the wicks, then, and you brought this over and price went up, it took a long time. It took weeks, months, or whatever, and then price came back down. But look, when it did, it didn't go below the support, and you had the wicks on it. This was a lot of up and down here that could have been traded. But so that's support. I showed you resistance, I showed you support, and this is all the easy stuff that most of my friends know about, but I'm going to pull it over and just kind of say this is a flip zone. So this was support, and then price fell through it. And when it fell through, it became resistance. So it came down under it, tried to hold, but it didn't. See the wicks? But then it got under, and then it went to retest it, and it failed, and then you had the wicks on the other side. So these wicks are showing you that there's a key level there, and this now was, this was support, became resistance. In this area, I would have just made it red. But you see that whole zone is your resistance. So that's the basics, the very basics. And that's why you want to know your key levels, because you'll have this rectangle drawn before price returns to that level. So you can expect a reaction to it when price returns to it, or a possible reversal that you can trade or scalp the reaction to it on a low time frame. And you will get massive reactions to these key levels on these high time frames. So now that I've covered resistance, support, flip zones, support, resistance, flips, it goes both ways, I will cover some other things like fair value gaps. Let's take a look at that. And what a fair value gap is when let's do the monthly. When price moves, when there's a big candle, not a wick, just the candle body is really big, you will have a gap between the previous candle's wick and the candle after the big candle's wick. And if you draw a rectangle in that gap, you'll get a fair value gap. And then that's right there, another zone you could trade. And this goes both ways, bullish and bearish. I'll show you both. So price went up so fast, and these are months, by the way. So this would have been 1 month, 2 months, 3 months. And basically, this gap, it has a very high percentage of being filled. That means that it's very likely that price would return to it. And so if you drew this right around here, it would have taken some months for it to fill, but you would have had it on there, and you would have known, if price doesn't get below this bottom line, there's a strong chance for price to reverse here. And you start seeing on this high time frame these wicks again, showing that this price is reacting to this key level, because a fair value gap can be a key level. And that's like a bullish one where price went above and came back down and used it as support. But that's fair value gaps work like that. And I put one on a different one. I knew I was looking at it before. This was a bearish one on another time frame. Which time frame was I on? Yeah, the 1 hour. So this one's a bearish fair value gap. And price was coming down, and there was a big candle, and the previous wick was up here, and then the candle after the big candle had a wick way down here. So this area of candle body where there was no wicks on those candles right next to it made this fair value gap. And in this case, price wanted to come back to it. It was still kind of going down, but before it went down, it wanted to come and fill this fair value gap. It wanted to do that. And it didn't even close a candle body above it. So it took a while, some hours or days or whatever, and then it came back and filled it and immediately had a reaction down and went above, and it came back down again. But if you look at these in different situations on whatever time frame, you'll see how they work and how they get filled, how price fills them before it moves in many cases. So that's fair value gaps. Pretty simple. And for all you guys in our group, I know you probably know all this stuff I've talked about, but it's going to get a little more interesting. A lot of you probably also know what I'm about to talk about right now, but I'm going to just dive into order blocks. Order blocks are also supply zones and demand zones. And if it's a demand zone, that means it's bullish because there's a demand that people want to buy at that area. And if it's a supply zone, there's supply there where people want to sell. And so basically, let's actually do the daily. This is how these work. Now, if you have I'm looking for a good example. Here's a good example. If you have a big move, like a big bullish move, this whole series of bullish candles and this trend on Bitcoin on the daily, it was going up for days, but it had little breaks on its way up. And these red candles become order blocks. Now, the order blocks is just a general word to include supply zones and demand zones. But order blocks are also similar, where price may return to it. There may be a huge whale or a big rich person that wants to place an order, and he doesn't care about a month passing. He wants to place his order at a certain price, and it might not get filled. And in the process of, let's say there was some guy that started buying Bitcoin here, maybe that's around the time of the ETFs, I don't know. But basically, in this series of green candles, the last red candle would be an order block, or even this series, really, because that would just be a series of red. These series of red candles would be like one red candle on a higher time frame. So here's a good example, and I would make like a rectangle box like here, and I would make it so the wicks are included, unlike fair value gaps. And so that candle becomes the order block. And even price came back down to it here and hit the middle of it. It will often hit the middle of these order blocks. And sometimes you'll get it go through, but right here it came back to it. So the same goes with a bearish scenario. So this would be a bearish one. So you had like a series of pretty big red candles coming down after this big run. And if you drew a rectangle on that, a Gann box, from the top on the bottom of the wicks of the opposite colored candle of that series and that downtrend, this box here would be your order block zone. And basically, somebody wanted to sell at that price, and they didn't get it all sold. Somebody else bought, and the price came back up or whatever. And there was more for sale up here. So if price got up there, their order would automatically sell. Their order block would cause the price to go down. So these are big orders, or a bunch of people having to order at the same area. So this one, was price came down and went back up to it, you would be looking for a reversal or potential signs of reversal, like these wicks starting to form. And in many cases, most of the time, you will get a touch of the middle of the 50% mark for the order block. That can also be an invalidation line. If a candle closes above it, it may be the order may be taken care of, and it may not be strong enough to reverse price anymore. But in this case, it kind of went further and it hit it more. So that was a strong order block. If somebody probably wanted to sell a lot at that price and they just left their order, who knows how it works, but that's the theory of it, of what's probably going on. Or people just know that there's going to be sellers at that area, and a lot of people set their sell order at that area because of this order block on this daily time frame. So that's pretty much how order blocks are. I will see these so much, and they hit so much. I mean, they are great ways to trade. And like this, like some of these other ones, I'm going to try to find a different example if I can. It's not another, that one's not really a great example. But this one, here's another order block here, but because these big candles moving up, but sometimes you'll see one little candle right in the middle of the move, and it will be, see, this was kind of a whole order block zone, and no candles were able to close below the middle line. And then when it filled, this was a demand zone. When it filled, the price started going up. It even came back and touched it again. So in these key levels, support, resistance, flip zones, fair value gaps, order blocks, they, I would say, would also cause people's algorithms, if they're using bots to trade, it would cause them to place orders. So there's they're well-known levels in trading. The 4 hour, I would say, is a good level to put them on. Sometimes this one didn't, but sometimes you'll get a tap it like exactly on it. So yeah, anyway, that's order blocks, supply and demand. And I'll get into, actually, I'll do monthly time frame and start talking about opposing levels, because this is the newer stuff. This is the stuff that not a lot of people know about, stuff that I learned through Easy Algo. Really important stuff. Very good, good data on here. I mean, it really is like order blocks, but it's just more simple. It's more simplified. So these, I'll look for an opposing level. Actually, I'll use a lower time frame, like an hour or something. It'll just be easier. There'll be more candles. But now the opposing levels do work better, I think. You can set them on higher time frames, and they do work better on high time frames. But these are great for trading continuations and things. And they're similar to order blocks. But you will, let's say you have a price trending down, and then you have a pullback, like a retracement. Could be anywhere here, and I'll just use this one as an example. So right here, as the price came down from these red candles, all of a sudden you got some green candle, like they're throwing on the brakes and saying, I want to buy here. And basically that is opposing the trend. It's like an opposing level that gets created when when that candle forms and closes. And so if you drew a line right here on the bottom of this green candle body, it'll create an opposing level, or it would even be like on these ones too, I would say, but they didn't close a body below. Like if they would have closed the body below this line, you would want to short it, because it would mean that it broke that opposing candle that was like trying to be in opposition to the downtrend. It would show that, very quickly, to show that if price goes below that and closes a candle body below it, you're probably gonna have a move down, and it works very well, and it's very easy to do. So this didn't close body, so I just leave the line right here. And the price did bounce on it, but then when it got here, by the time this closed well under it, you could have entered a short right here. And this is a 1 hour time frame, so if you entered on a low time, that would have been a good move for Bitcoin. Say like on this next candle that started here, you could have got in, or on this wick. And who knows how far you could have shorted it. I mean, 3%, 3.41% doesn't sound like much, but with Bitcoin, people use higher leverage, and the numbers would be way bigger on altcoins for these types of deals here. So basically, you're looking for something that opposes the trend to get broken. Like here's a bullish scenario. Price is trending upwards, and there's a lot of examples for this one. So if price is going up and then you have a series of red candles going down, if you draw a line on the top of the red candle body and then price blasts through it and comes back down, this starts closing candles above this line. This could be your entry for a long. And as you see, this happens again and again. And I'll just show you, like, it went up again. You had an opposing candle, but price wicked on it this time, but then it got above it. And you could have went long, although it dipped down. They may look different on different time frames, and that's why sometimes you'll have these go way down. But here's a good example. If this set of red candles was opposing the trend, you could draw your line right here on the top of the red candle's body, not the wick. And at this line, as soon as you get a candle close above it, you know that this has been broken. This opposing level's been broken, and the trend wants to continue. So when price, it might, you could have entered here or something, but if price would come back and retrace to it, you would be looking for a sign of reversal, especially if you had this candle go up and then another one come down. You'd watch it very closely. And if this candle's timer ran out by the time, if this closed and it was still like above, there was a good chance that it was going to go up. And it hit this opposing level a bunch. And look at this. Look at all these reactions to this opposing level. See, that kind of narrows down drawing your support or flip zone. Because in this case, it ended up being a flip zone as well. But you didn't have to have a zone. It was just really just a line. So those are opposing levels. And when you see these work on all sorts of time frames, like here's more examples. Like price was blasting off upside, and then you had all of a sudden 2 red candles go down, and you draw a line on the top of the red, and then candle busts through. The very next ones, are bullish. So there's a good chance that entering somewhere around here, around this line for long, would give you a move. But as the trend progresses, you don't want to keep doing that, because eventually the trend's going to reverse, and those opposing levels aren't going to be good, and you're going to want opposing levels to the downside or upside, depending on the reversal if it occurs. So those are opposing levels. Those are really good. I really can't get too deep into that, because it would be a whole video in itself, but opposing levels are really one of the better ways to find entries for key levels. And with that being said, one of the very best ways to find key levels is with liquidity, high time frame liquidity, like daily, 4 hour, daily, and above. So if I turned on one of my indicators, say like indicator X or something, maybe SMCX as well. And I'll get rid of this line here. So I don't know if you might be able to see it, but I've got my liquidity lines very faint. And this is a daily time frame. So whenever there's a swing high or a swing low, you'll have liquidity. There will be people that have really entered trades on these wicks. Like at the tips of these wicks, there will be stop losses around that area. And let's say the guys that were the market makers or whales or whoever it is that can kind of, or just price in general is going to want to reverse because it just had a big trend up. There would be people saying, okay, it's going to reverse, and they'd be looking to enter shorts on some of these moves, like in the middle of this day, or where the price was way up here. They may have seen signs of the reversal and entered a short, and then price came down, but it wasn't truly reversing yet, and price came up again to hit this liquidity line. And so right around here at the tip of this wick, you want to look for like signs of reversal here once this liquidity was taken out. And right here, it's so evident. Like when you see the tip of this wick creating this red line, a liquidity zone, and it stayed there for a while. That meant people probably had some shorts opened and they rode it all the way down. But price didn't come up to it for a while, and then it did. And at the same time, it was taking liquidity down here. Like this candle took this one, or sorry, this one took the liquidity down on this one, and this one here took this one that was here for a while. Somebody might have been in a long from here, and they were coming to hit their stop loss. Who knows? Maybe people are on such high leverage they get liquidated at those levels. But there's liquidity there. There's money to be had at these swing highs and swing lows. And sometimes it's a little above it. Somebody might set their stop loss up higher or something. But price will seek out liquidity, and it will move from liquidity to liquidity. So without drawing these lines, you can draw them. I can plot these out like this with this indicator from Easy Algo, which is great. But I can draw them and say, okay, well, here's a line, and I can just say it's liquidity green. And so at the end of that wick on that crazy candle, I would expect price to come down to that liquidity one day if it's really going to reverse. And in this case, like it came down for that liquidity and then reversed back to the upside. So it's the same way. You can draw these, and these are key levels. The liquidity areas, there's a lot that happens at these areas. So I would draw like a red liquidity line at this wick, hoping and that knowing that it's very likely for price to come back up to that. So that's a key level. And then once if you got down on a very low time frame, you would see stuff going on right there. You would see a lot of volatility. It's basically sweeping liquidity. They're pushing price into it to take whatever orders, stop losses, or liquidations might be there, and they're hitting it. And then they're reversing price. They want to move from liquidity to liquidity so that the big guys can fill their orders, and then the big guys can enter a short, because they can't even really enter unless somebody else has lost money, or it takes a lot for them to fill their order books for their limit orders. And that's why it takes price a few times to go to a certain level to hit an order block or liquidity a couple times, sometimes before that order is filled and the price reverses, because an order that was so big finally got filled and just basically cause price to reverse. But you see price coming down, hitting liquidity, going up a little bit, coming back down, hitting liquidity again, going up. This time it went. But it's often time for a reversal around these key levels of liquidity. I would say that's one of the best levels where a lot happens. So with all this being said, your support, resistance, your flip zones, your fair value gaps, your order blocks, opposing levels, liquidity. There are other key levels like volume areas, which I'm going to talk more about that in its own video, but I can use a fixed range volume profile in some area that's ranging, that where price is going sideways. And if I zoomed into this, you would see price went up and down in between these red and green lines over and over. And these, this is the value area high, the value area low, and the white line's the point of control where the most volume is traded, where the most trading volume is located at or averaged. And these can be key levels as well. You see price reacting to it. So the thing I'm trying to tell you is that your trading results are going to be more successful if you trade at key levels. Out of all my videos, out of all the things I say, this is like probably one of the most important things. And I heard someone else in our group say it once. He said, if price is not at a key level, you have no business entering a trade. And that's the truth, because if you're just jumping in a trade, anything can happen. But if you're at a key level and you've had a big move and you see confluence, like the RSI being overbought or oversold at the key level, or a divergence at the key level, or a Fibonacci line hit at a key level, you have a good idea that a reversal will occur. So yeah, that's it. This is an interesting one. There was I would say an order block around here and a Fibonacci level. So Fibonacci's can also create key levels, but I'm going to talk more about that in another video. Just like the volume profiles and tools like Fibonacci, I'll talk about those in other videos. But yeah, that's the basics of key levels and why you want to trade at them, because they're much stronger and you get better reactions at key levels than you do with trend lines. And yeah, thanks for watching. Oh, and by the way, if you're not a member of Easy Algo, you can look in the description of the video, and if you want to learn to trade and make some money, it's not that hard. We have tutorials. These tutorials that I show you on my YouTube channel, they're nothing compared to what the group offers. I learned what I learned through our group that I'm a member of, and now I'm a mentor in it. But if you click the links in there, if you want to join our group, it will help me. It's an affiliate link, so I'll get a little bit out of it, and I'd appreciate it if you click those. And if you join through one of my affiliate links, I will definitely put you on my friends list and do my best to help you and mentor you if you want to learn how to trade. So thanks for watching, and if you haven't joined Easy Algo, you're welcome to.